Hi, Steve Van Metre here, and welcome to your weekly economic update where we take about 30 minutes every Friday trying to make sense of markets that somewhat make sense. I know we're upgrading from the never make sense to somewhat make sense today, because while the market's fixated on stocks are down 2 days in a row, oh my God, the Fed needs to ease and do a whole bunch of stuff, 30-year Treasury yields made an intraday new all-time low and closed at their second lowest yield in history. And nobody's talking about that, which is really interesting because how many people said that quantitative easing, even though the Fed's not quite really doing quantitative easing, but nevertheless, something really, really similar to it, and rate cuts lead to higher interest rates. We've had 3 rate cuts, and I don't, how many months of $60 billion per month of asset purchases plus, a couple $100 billion of overnight dollar loans. Excuse me. And interest rates on the 30-year are at their second lowest closing level in history. See, investors don't get it. All this Fed's mojo, all their magic, it's not inflationary until it is. And until it is inflationary, it's deflationary. Low interest rates themselves are deflationary. As I shared with a class I taught last night, that we're all conditioned to think that low interest rates are inflationary because it creates a surge of demand of borrowing. But it's the destruction of money. See, when you borrow money, take a new loan, money gets injected into the economy. As you make payments back on that loan, the principal payment is destroyed, leaving the interest, however big that is, to stay in the economy. Well, if interest rates are near zero or negative or really low, well, most of the money borrowed gets destroyed in a relatively short period of time. Back in the 80s, the reason inflation didn't go away is because you had 18% mortgages. And that interest was just still there. It couldn't go away. You want to kill inflation? Go to zero. Yeah, you'll get a huge surge in lending growth. And then once it dies, it's over. So we don't really have inflation. And the bond market is telling you everything. The bond market is the sayer of truth. When interest rates are low, it's a symptom of tight financial conditions. And as we talked about in class last night, when the stock market is up and interest rates are down, this is not normal. This is a dislocation. See, normally, that's the way to do it, is stocks and interest rates rise in a trend together. Now, they're not lockstep exactly. They'll move around, but they trend up. And in bear markets, they trend down together. And at the onset of a bull market, usually you'll get a very short period where yields are rising and stocks are bottoming. But when you have this weird dislocation where stocks are up and yields are down, the bond market's going to end up being right at some point. This is the largest dislocation and the longest dislocation in history of the markets. Yet stock investors believe inflation's coming. And what's weird to me is American investors who always say, now, don't worry, I got burned by the last 2 recessions. This time I will not. I'll see it coming a mile away. Okay, look, maybe you could look several thousand miles away over to, say, China, South Korea, Iran, and some of these other countries that are having growing problems with the coronavirus that is literally shutting down the supply chain. No, investors can't see it. They think, it's just a flu. Americans are really great about that. Until it shows up on our doorstep, it's not a problem. Oh, it's at the neighbor's house? It's okay. Oh, it's over there across the street? No big deal. But when it shows up on our front door and someone we know has that problem, whatever the problem going on in the world is, then it becomes real. So for most American investors, the coronavirus isn't real. It's just a flu. If you don't believe me, then why is the stock market only down 2 days since its peak? Because American investors aren't worried. They have no concern. It doesn't make any sense to me. But the part of the market that does make sense to me is the bond market, because it's telling us, look, not only are financial conditions super tight, but there's a lot of risks out there that are going to further tighten financial conditions. So the coronavirus, the trade war, and he said, well, the trade war ended. Well, the tariffs didn't go away. Some of them did, but not all of them. Most of them are still in place. That's still going on. So demand is falling. It hasn't flown across to the United States yet. Now, maybe the coronavirus is here in some areas. I don't know. Obviously, there's a lot about its incubation and, well, a lot about itself. We just don't know. And this video is not about that. This is about the economic effects that Americans haven't seen. You know, when a factory here finally does get turned off because they can't get a part, maybe people will realize, or maybe when they go to a store and say, hey, that thing I like to buy is gone and it's out of stock indefinitely. Why? Because the factories are shut down. This is pretty serious stuff. And all it tells you is interest rates are going even lower. In fact, I think they're going to go lower than I predicted. I mean, now I'm not going to be surprised if we see even deeper into negative territory. I thought 10-year Treasury would just dip into negative territory. They may go deeper. Because remember last week when we looked at how the hedge funds managers were positioned, they're still net short. Well, we're going to find out Monday if they're still net short on last Tuesday. Because the more people that are short this market, the bigger that move up in bond prices. In fact, I bet nobody reported today that the TLT, the 20-plus year Treasury bond fund ETF, closed at a new all-time high today. I bet nobody reported that. So that's what I'm struggling with today is investors are very complacent in the face of danger. And if you really want to know the market, see, everybody thinks the stock market tells you everything. I share this with my clients. Everybody's so fixated. Oh, and stocks, the stocks this, the stocks that. You want to know where the truth is? Do you want to know who the real sayer of truth is? Always. It's the bond market. And it's screaming at you. I mean, look at the federal funds rate. It's at 1.5%. Where did 10-year Treasuries close today? 1.47%. They are inverted. When we look at the lending data here shortly, you're going to say, well, why is the lending data weakening? Because the banks can't make money when rates are inverted. It's going to mean the Fed's going to have to cut. I mean, we had no less than 3 Fed speakers today had to come out and talk about the coronavirus. Really? Because monetary policy can make that go away? Nope. If the car you want to buy is not being able to be built because a factory shut down, I don't care if interest rates are minus infinity. It won't make any difference. It will not make any difference at all. Let's go a different order today. Let's do the web pages and then we'll hit the charts. The NASDAQ McClellan Summation Index is not showing a lot of liquidity strength here. It's backing off. I mean, obviously the markets want rising liquidity. The Fed is scaling back on their asset purchases in terms of their term dollar loans. And I don't know when their next leg down is. It may be next week where they drop from, they're doing 225 billion term loan, 14-day term loans, dollar loans. And I think they might be switching down next week or the week after that. Let's take a look at the assets and liabilities of all commercial banks. And this is very interesting. So in terms of securities, there's a big drop off in banks holding bonds. Wait a minute, then interest rates should be going up. And they went down. Now, are they offloading some of these to the Fed over the short term? Is the Fed now reaching in and buying them off the banks? I don't know, and we won't know. But you can see that Treasury agency securities dropped, and mainly due to a big drop in mortgage-backed securities and a small drop in Treasury bonds. So that's pretty interesting that those two went down. But look at all loans and leases. Maybe the reason the banks don't need so many bonds, or maybe they're not anticipating, is that all loans and leases dropped $5 billion this last week. That's impressive. Commercial industrial lending down $2 billion. There's a surprise. Not really, but it's not going up. So here in about a couple months, this thing is going to go negative or just be at zero for a long time. Real estate loans dropped $5 billion. That's interesting. With residential real estate loans down 6, commercial real estate loans up 2. How about consumers? What are they up to? A whole lot of nothing. $1 billion of new loans there. And where is that mostly coming from? Credit cards. And let's see how automobiles are still flat. So not much going on in the automobile sector. And it just tells us that when you have weak lending growth, you don't have inflation, which is troubling to me of why everyone's so fixated on gold. And believe me, I really like gold, but I don't like it when it's got the largest speculative long position in history. Because gold is technically supposed to be your inflation hedge. There's no inflation. I mean, the chart, we just saw the charts, and there's really no inflation. And yet people think, oh, look, this coronavirus is going to drive gold prices up. Look, we have a dollar liquidity shortage. We're short dollars. Can you pay your mortgage in dollars? No. Can you pay your credit card bill? I mean, not dollar, in gold? No. Credit card bill in gold? No. Can you pay anything in gold? No. You go to the bank, what do they say? Well, here's my gold bar. I'd like to make a payment. No, convert it. Go home and convert it. Go somewhere and convert it to dollars. See, that's why I think that gold sold off in the last financial crisis, is because there was a dollar shortage then, and people need dollars. And, if you lose your job, let's say your hours get cut, your overtime is gone, and you can't make a payment on something, you're like, man, the repo man's going to come and take my car. I need my car to try to go to work, to get a job. And you need what? Dollars. So what are you going to do? You're going to sell something, and gold is very liquid. So I still think gold's got a leg down. I really think gold does. Let's go and take a look at the charts. Here we go. Excuse me, still getting over this lung thing. I apologize. But again, no editing, because what fun is that? No editing. M2 money supply growth is up to 7.23%. The 6-month and 3-month rate changes are flat. And with the Fed backing off their monetary pumping, it'll be interesting to see where this goes. Still, a lot of this is sitting in money market accounts, and everyone thinks that that's going to turn into stock purchases. Don't think so. Well, that's what the market thinks. Real estate lending growth is down to 4.38%. We saw that it dropped $5 billion in residential lending. The 6-month rate of change slipped this week. 3-month rate of change is falling. They're still sitting and validating roughly the year-on-year growth rate is still correct. But isn't this staggering? You now have mortgage rates near or at their all-time low. And the best we get is a 4% growth rate over last year. It tells you mortgage rates are not low enough. They're going lower, a lot lower. And look at commercial industrial lending. Growth rate is now, year over year is down to 0.78%. That's really low. The 6-month rate change is negative 1.1. Now, and historically, when the 6-month rate change hits -1, bad things really start happening. I don't think that's quite there yet. But the fact that banks aren't needing to hold on to bonds as much, at least over last week, and interest rates fell, it tells you something. It tells you lending growth is weak. They don't make money when yield curves are inverted. 3-month rate of change is negative but rose slightly. And loans and leases and all bank credit represented a third of all total loans. In the marketplace, growth rate is flat at 4% from a year ago. Historically, that is super weak. You can see historically the lending growth when it gets down to this, say, roughly 6% level, you're kind of running out of steam. So this is very recessionary to begin with. The 6-month rate of change is at 1.5% and falling, suggesting that this is numbers coming down. And the 3-month rate of change is at 0.76 and falling, again, suggesting the year-over-year rate is headed lower. And how about consumers on their credit cards? Growth rate is roughly flat at 4.45%. Now, is the market too complacent? This chart came out on Bloomberg. It says short interest on the S&P 500 ETF is near the lowest since 2007, meaning everybody that is long the market and everybody thinks stocks are going up. Everybody thinks the stocks are cheap. Everybody wants to buy stocks. Everybody owns stocks. And they're so confident about it, their downside protection is almost at the lowest level before the great financial crisis. Wow. Now, this is a great chart by McClellan Financial Publications, who posted this on Twitter, and they were commenting about how this rise in gold doesn't seem to make sense. They said, look, when the Japanese yen goes down and gold prices go up, usually gold is wrong. So it says the yen is usually right. So he says here the yen is going down and gold went up. So that was one time it was wrong. But here, yen going down, gold going up, gold corrected down. Yen going up, gold going down, and then gold went up. Yen going, I think actually it's these two. Yen went up, gold went down. And so there was a little change here, and the yen went down and gold went up. But for the most part, when the yen goes down, you can see gold is and gold is going up. That means gold is going down. So he says, look, the probabilities are favorable here that gold is in a speculative run, which we know because we have looked at the speculative positioning, which is a preview to Monday. It just hit its record high. Now, Hendrik Zerberg on Twitter, at Hendrik Zerberg, posted 3 charts today about gold. And he said, one is wrong. Silver usually leads in bull markets. Of course, he immediately got replies that said, no, you're wrong, which is interesting because I ran my own chart and his chart was right. Silver went up, gold followed. Silver went down, gold followed. Gold went up and silver is down here, which means either if gold is going into a bull market, then silver is there's still plenty of opportunity in silver. And if gold is wrong, and silver's right, then gold is coming back down. That's probably where you get your buy. He also mentioned in Treasury inflation securities, usually follow gold. And so he said, look, one is wrong. Tips and gold move together. And effectively, here's gold, here's tips. And he's saying, look, mind the gap. Gold is doing something it normally doesn't do, and it should follow tips. Now, that does make some sense. Because again, gold we talk about as a hedge against inflation. There's no inflation in the lending data, and the Fed isn't. If even Fed goes to zero, it's not inflationary until it is inflationary. You got to remember, it's not inflationary until it becomes inflationary. And that's a huge misunderstanding investors have. They just think, oh, you go to zero or negative, and it magically becomes inflationary. Nope, not until you get lending growth. You have to have the two paired together. You could have interest rates at minus infinity, and if no one borrowed money, it's not inflationary. Just that simple. So what is a Treasury inflation protected security? It's just a bond that pays an increasing rate of interest if inflation goes up. So what are we seeing? We're seeing investors that have been bidding up tips, but also chasing gold, thinking there's inflation. Again, it's not. I still think we get a pullback here. Could be wrong, but if I am, silver is still an opportunity. How about the gold miners? Gold miners have not participated in this big rally in gold. And remember, miners usually lead the metal. And I've said this before, and then he kind of mentioned it again. One is wrong. Miners usually lead the metal. That is so true. And when it doesn't, it tells you that gold is likely headed lower. So let's go and take a look at some charts. There we go. No editing. Because what fun is that? S&P 500, 2 down days in a row, call the Fed. We've got a major emergency here. But what is notable is investors are buying the dip. We see investors clearly doing that. We see computer algorithms buying the dip because looking at the VIX back over 2 years, we're still seeing the VIX trending lower. And those 2-year volatility control strategies on their tail saying, hey, if volatility over 2 years is falling, you buy stocks. Volatility is obviously trying to rise. Why? Well, because of the bond market. The bond market is yanking liquidity out of a market that doesn't have much liquidity. And that's fantastic if you are long bonds right now. Here's a 10-year Treasury yield. Broke down this diagonal pattern, broke this diagonal pattern. I said this sets up a run at the all-time lows, which is getting close to on 10-year Treasury. Now, you see people came in and they sold bonds and fought back. Now, it makes sense. Why would that be? Because what yields rose up into this cluster here to find out, hey, all those people that sold bonds back here, do you still want to sell? So the market's got to find that out. Do the people that sold here and maybe here, so it's possible we might see yields on Monday, maybe depending on coronavirus news, maybe back up a little bit and try to see, hey, are the sellers still around? If they're not, the yields will head back lower. And what is the big opportunity in 10-year Treasury yields and in the bond market in general? And that is this chart right here, a triple bottom in 10-year Treasury yields, just around 1.4%. You break this 1.4, and there you're setting up 10-year Treasury yields going to zero or more likely negative, depending on if speculators are still short, because we know most investors don't own any bonds, and we do know these momentum strategies at some point will start switching over and buying bonds, and that will start yanking liquidity and forcing other strategies to shift over and start buying bonds. So if you're in bonds, you're in the front of the line. You know, and the great thing about the markets is if you wait long enough, you can go from last to first. And what you don't want to be is you don't want to be last into stocks. or last into bonds. You want to be, if you can be first into one of them, you can break the mold. So in this case, if you're in the bond market, you're moving quickly to the front of the line. Let's take a look at 30-year yields. They've been trending lower. I remember how many people have told me that I was completely wrong about the bond market. There you have it. New intraday historic low, second lowest closing price in history on the bond market. Actually, you know what? I may be wrong. This may be the actual lowest. No, it is the lowest closing price on 30 years. I'm sorry, I said second, and I posted on the website. I was wrong. It is the lowest closing value at 1.915 is where it closed. And with that, you can go look to TLT, all-time closing high on this ETF. And remember, people's like, oh, but look, these Fed rate cuts, these arrows here, those are so inflationary. Yes, they're so inflationary that bond prices are making new all-time high. And quantitative easing, the Fed's buying $60 billion a month. That's so inflationary. Yep, there you go, new all-time high. Oh, but the Fed's doing overnight dollar loans, new all-time high. The bond market screaming at stock investors saying, look, you're offsides. Blow the whistle. You're wrong. How many people told me that I had no idea what I was talking about in the bond market? There you have new all-time closing high on TLT, new all-time closing high on 30-year zeros, new all-time closing high. Let's see. High 114.3. Nope, didn't make it there. Didn't make it on short-term bonds. Look, the money's to be made in the long-term. The longer the duration, the bigger your payday. We're still, I don't think, squeezed out all these short people. Now, let's take a look at what happened in the bond market here on TLT today. So it went up in early trading, and so those of you that are watching were very excited, and then it came back down, and you're like, oh no. Well, here's what I've added. I moved this line up here, and what it was doing is just checking with these people here. Hey, are any of you here that were sellers that sold here still want to sell? And the answer was, well, not really. And all this is setting up is the bull market move in bonds, and it is only yet begun. There's a huge move coming in bonds. Let's talk about the goal. I mean, just think, if you don't believe that, look, the coronavirus is something no one could factor. Not even the smart money has been buying bonds for 3 years could factor this. And what is it telling us? They're on the right side of the market, well better off than they ever could imagine. Because the worse the coronavirus gets, the longer things are shut down, it just means the Fed is going to have to lower rates to zero and do even more quantitative easing. If you own bonds, you can make a ton of money. Let's talk about crude oil for a minute. People are still very long crude. People still believe crude is going up. People are buying crude positions. And why are they doing that? Now, if you work in the oil and gas industry, especially if you worked at a refinery, you're going to love what I'm about to say because you're going to laugh. People believe that the coronavirus is going to force the shutdown of refineries. That's funny, huh? I told you it was good, because anybody that's worked at a refinery knows, one, you never shut the thing down unless it's coming from the very, very top. You never, ever shut the thing off. Number two, I don't care. They don't care how sick you are. And if you're too sick to come to work, they will get someone else. And if they're too sick, they will get someone else. Because you see, number one, you never shut the thing down. But yet for now, what's going on is people believe that refineries are just going to all magically start shutting down due to the coronavirus as it expands. And that's going to take oil to $100 a barrel. Yeah, good luck with that. Oil companies do not shut down refineries. It costs way too much money to shut them down. It costs even more to bring them back. There's no way they will find people to go out there and do whatever needs to be done to keep it running. So let's take a look at crude. Came back over resistance here at 52 and got into 53. I am a bit surprised. As you know, I thought it would run out of steam here instead of move lower. It did not. It got up in here, reconfirmed resistance. This was just now become support, setting up a possible move higher in crude, which is, again, shocking to me, given where global demand in crude oil is headed. The real risk to crude, remains when it does eventually turn down because global demand is going to evaporate. It doesn't hold 45. If it doesn't hold 45, you're going to see crude down here in the 20s again. From a technical perspective, you're going to see people selling, and all of a sudden this thing's going to go. So that means we need to go look at oil stocks. So let's take a look at the ETFs real quick. Let's look at the largest one, XLE, which is really our proxy for Chevron and Exxon Mobil in reverse order. Exxon is a larger position here. And we can look out here and we see that it's trying to find buyers right in here at $54 a share. And it found buyers here last time and took off, but notice there's way less volume here, suggesting that the people that bought in here have sold out. So the markets now is going to keep looking past, say, hey, buyers here, doesn't look like it, suggesting that the next move lower is going to be in the mid 40s. Let's go look at small oil and gas producers, symbol XOP. This thing is a disaster of a chart, suggesting that if you're looking to buy low, wait till this thing bottoms out. Now you may say, well, look, it's kind of bottoming here. We haven't even begun to see the slowdown from the coronavirus in the United States or the rest of the world at this point. This thing is still hanging on a little bit, but not much. It tagged its all-time low 4 days ago. This is weak and likely headed lower. Now let's go look at Exxon Mobil. And we'll zoom out to the weekly chart. And I drew this line in here at roughly its all-time, or not all-time low, at its daily low today. And I did that for a reason, because I wanted you to see how close Exxon is from falling off this last of this cliff. It's looking to find out if the people that bought in 2010 are still buyers. And it's not finding a lot of them, suggesting that the people that bought here and here have taken the opportunity to sell. Now, we know that because there are insider reports of what executives at major companies do. So we know they've been selling. And then we're going to go, and then the market's going to try to figure out if all the people that bought back here in even 2005 and 6 still want to buy. If not, and it's not looking like it, Exxon's got a long ways to go, and that threatens to drag the whole market with it. Let's take a look at Boeing. Remember, it found buyers here at 310, went up, ran into resistance, and now it's headed lower. The question is, if Boeing moves through this 329 level, it's going to retest support at 310 to 320. The question is, can it hold? If it doesn't, you're talking about breaking this massive topping structure here. And if anybody knows what happens to airline stocks during recessions, they go down a lot. So a lot of risk there. How about the ags? I know everyone thinks the ag commodities are left for dead. Let me tell you this. Not only is there a massive locust swarm that you're not reading about that is busy chewing up crops in a matter of hours wherever it goes. Now, how big is this swarm of locusts? Well, it's the largest swarm in 70 years. And of biblical proportions, there are estimates there are about 360 billion locusts and growing. And when they hit some crops, they said they're devastated within hours. Can't stop them. They have now shown up in the Middle East. They are in some parts of China, although it's not expected to get into mainland China, but they're there. But they're just tearing up Africa. And on top of that, Australia, who is a major exporter of ag goods, is having massive problems there and is looking like they're going to be importing goods again. Who's got ag commodities? The United States. Now, think of that when you look at these charting patterns. Because remember, we've had massive floods. We've had the swine flu, we've had chicken flu, and potentially we even have people that may not be able to go out and farm because of the coronavirus, or if they can, may not be able to get it in to be processed or done with anything. Left shoulder, head, right shoulder. It's got some headwinds in the moving averages here, but it's fighting up. This is a bottoming pattern telling you that ag commodity prices will be going higher. That's what this is telling us. Let's take a look at the dollar. And the dollar came out and hit overhead resistance here, where it's run into resistance in the past, immediately found sellers today. If the dollar can hold right in this range here, it's extremely bullish. A lot of people think it's going to come back and reconfirm down here in the 98. That's bullish too. But if it sets up right in here and holds roughly where it closed today, it's setting up a huge move higher in the dollar. And you're going to watch U.S. exports get annihilated. You're going to watch gold probably gold get annihilated. Crude oil get annihilated. And the U.S. stock market blow up. It's happened before, and it'll probably happen again. Well, that's our update for the week. We'll be back Monday to see, hopefully, I'll be excited to see if the hedge funds are still long or short the bond market, because if they are, that's really good for everyone that owns bonds. Tells you that perhaps due to the coronavirus and all the speculative positioning and all the people who don't own bonds, which is pretty much everybody, that interest rates are going to go much lower than even I think. And that means bonds are going to be the big superstar. Of course, because the news didn't tell you that interest rates are at a 100-year low on 30-year Treasury yields, did they? Didn't hear that. I'm Steven Van Metre. Thanks for watching. We'll see you Monday. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicitation by selling security, financial product instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Business press video that I'm on do not reflect the view of Alice Financial Advising or Steven Van Metre Financial.